The numbers just came in, and what I'm about to show you is something most people won't hear about until it's too late. We're not talking about a temporary shortage or a minor supply disruption. We're talking about a fundamental shift in the global commodity markets that's already in motion, and the implications are staggering. Let me start with copper. The International Copper Study Group just revised their mine supply growth projections downward to 1.4% from 2.3%. That might not sound dramatic until you understand what's happening on the demand side. Demand is projected to increase significantly, driven by the energy transition, electric vehicles, renewable energy infrastructure, and data centers. We're looking at a structural deficit starting this year that could reach 19 million metric tons by mid-century. Think about that number. 19 million metric tons of copper that the world will need but won't have. But copper is just the beginning of this story. Let's talk about silver, because what's happening in the silver market right now is nothing short of extraordinary. Supply disruptions combined with exploding demand from artificial intelligence infrastructure, solar panels, and electronics manufacturing have created what analysts are calling a market squeeze that's transforming global commodity trading. Silver isn't just a precious metal anymore. It's become a critical industrial commodity at the exact moment when supply chains are fracturing. Here's where this gets really interesting. The materials that everyone thought would be in shortage, nickel and cobalt, have actually shifted from projected shortages to possible surpluses. Meanwhile, the materials that power the modern economy, copper and silver, are heading into deficits that could reshape global trade. This isn't random. This is the market telling us something profound about where the world economy is actually heading versus where everyone thought it was heading. Let me paint you a picture of what's really happening behind the scenes. China dominates the supply chains for these critical materials, not just dominates, controls. And right now we're seeing new escalations in tensions between the United States and China, with protective measures being implemented for the European steel market. When you have the world's largest consumer of commodities and the world's largest producer of commodities in an escalating trade conflict, supply doesn't just get tight, it gets weaponized. Think about the last time we saw commodity supply chains used as geopolitical leverage, the 1970s oil embargo. That crisis reshaped the global economy for a generation. What we're seeing now has the potential to be even more disruptive because it's not just one commodity. It's the entire suite of materials that make modern technology possible. The copper deficit alone tells a story that should concern anyone paying attention. Copper is in everything. Your home's electrical wiring, the power grid, electric vehicles, wind turbines, solar installations, data centers, telecommunications infrastructure. The average electric vehicle uses 4 times more copper than a conventional car. A single offshore wind turbine uses up to 30 tons of copper. And we're trying to build thousands of these turbines while simultaneously electrifying transportation and expanding data center capacity for artificial intelligence. Do the math. The supply isn't there. Mine development takes 7 to 10 years from discovery to production. The projects that would supply copper in the early 2030s should have been started years ago. They weren't. Why? Because copper prices were too low to justify the massive capital expenditure required for new mines. Now prices are rising, but the supply response is years away. This is what economists call a structural deficit, and it's the kind of market condition that can persist for years, even decades. Let's talk about what this means for silver specifically, because silver's situation is unique. Silver has this dual nature. It's a monetary metal with thousands of years of history as money, but it's also an industrial metal that's absolutely critical for modern technology. Solar panels need silver. Electronics need silver. Medical equipment needs silver. And now, with the artificial intelligence boom, data centers need massive amounts of silver for their electrical components and cooling systems. Here's the problem. Silver mining is largely a byproduct of other mining operations. About 70% of silver comes as a byproduct of copper, lead, and zinc mining. So when those primary metals face supply constraints, silver supply gets constrained too. But silver demand isn't constrained, it's accelerating. The solar industry alone is projected to consume record amounts of silver over the next several years. Add in the electronics sector, add in the AI infrastructure build-out, and you have demand growing faster than supply can possibly respond. The silver market has always been smaller and more volatile than gold. The entire annual silver mine production is worth maybe $25 billion. That's less than the market cap of many individual tech companies. When you have a market that's small facing this kind of supply-demand imbalance, prices don't just rise gradually, they can spike violently. Now, I want to take a moment here because if you're sitting on retirement accounts worth $100,000 or more, this supply situation is something you need to understand in the context of wealth preservation. I've put together a comprehensive guide on how precious metals IRAs work, how you can get physical gold and silver into your retirement accounts without triggering tax penalties, and how to evaluate whether that makes sense for your situation. You'll find that in the description below. It covers the mechanics, the custodians, the storage options, everything you need to know. Worth checking out if this is relevant to your financial planning. But let's get back to the supply crisis because there's another layer to this that most people aren't seeing. The energy transition that's driving so much of this commodity demand, it requires massive amounts of materials. A typical electric vehicle battery needs copper, lithium, nickel, cobalt, and graphite. Wind turbines need rare earth elements for their magnets, copper for their generators, and steel for their structures. Solar panels need silver, copper, aluminum, and silicon. The infrastructure to support all of this, the charging stations, the upgraded power grids, the energy storage systems, requires even more materials. Here's the uncomfortable truth that's emerging. The energy transition as currently envisioned may not be physically possible with available material supplies, not because the technology doesn't work, but because the materials don't exist in sufficient quantities to build it all at the pace required. This is what supply chain analysts are starting to call the material constraint on the energy transition. Let me give you some specific numbers to illustrate this. To meet climate goals, the world needs to install about 600 gigawatts of solar capacity annually by 2030. Each gigawatt of solar capacity requires roughly 30 to 40 tons of silver. That's 18,000 to 24,000 tons of silver per year just for solar, at a time when total annual silver mine production is around 25,000 tons, and industrial demand from other sectors is already consuming most of that. The math doesn't work. The same calculation applies to copper. The energy transition requires doubling or tripling global copper production over the next 25 years. But copper mine production has been essentially flat for the past several years despite rising prices. The easy copper has been found and mined. What remains is lower-grade ore in more difficult locations, with higher extraction costs and longer development timelines. This brings us to a critical question. What happens when the world realizes that the supply isn't there? What happens when governments and corporations that have committed to electrification targets understand that the materials to meet those targets don't exist at any price? You get a scramble. You get hoarding. You get export restrictions. You get the kind of commodity nationalism that we're already starting to see with China's dominance of rare earth processing and battery material supply chains. China understood this years ago. While Western countries were focused on climate commitments and technology development, China was securing supply chains. They invested in mines around the world. They built processing capacity. They created strategic stockpiles. Now they control the supply of materials that the rest of the world desperately needs. That's not an accident. That's strategy. And here's where the geopolitical dimension becomes crucial. When you control the supply of materials that other countries need for their economic and national security, you have leverage. Enormous leverage. We're seeing this play out right now with rare earth elements, where China produces about 60% of global supply and controls about 90% of processing capacity. If they decided to restrict exports, the entire Western technology sector would face immediate shortages. The same dynamic is developing with copper and silver, just more slowly. China is the world's largest consumer of both metals. They're also increasingly controlling production through investments in mines globally. As supply tightens and deficits emerge, the country that controls the supply controls the price and controls access. This isn't just about economics. This is about power. Let me take you back to a historical parallel that's instructive here. In the early 1970s, the United States faced an oil crisis. OPEC, led by Middle Eastern producers, restricted supply and prices quadrupled. The economic impact was devastating. Inflation surged. Growth stalled. The stock market crashed. It took years for the economy to recover, and the recovery only came after massive investments in alternative energy sources and new oil production from non-OPEC countries. We're potentially facing a similar dynamic with industrial metals, but with a crucial difference. You can't easily substitute for copper or silver in their critical applications. You can't drill for more copper the way you can drill for more oil. The geology determines where copper exists, and most of the easy deposits have been found. New discoveries are rare, and even when they happen, Bringing a new mine into production takes a decade. This is why the supply situation we're facing isn't just a short-term disruption. It's a structural shift that could define the next decade of global economics. And most people have no idea it's happening, because the mainstream financial media is focused on interest rates, inflation data, and corporate earnings. They're missing the bigger story unfolding in the physical commodity markets. Let's talk about what this means for prices. When you have structural deficits in critical commodities, prices don't just rise to balance supply and demand. They rise to destroy demand. They rise until projects become uneconomical, until consumers find substitutes, until the pain of high prices forces behavioral change. We saw this with oil in 2008 when prices hit $147 per barrel. We saw it with lumber during the pandemic when prices increased fivefold. We're going to see it with copper and silver. The question isn't whether prices will rise. The question is how high they'll go and how long the shortage will persist. And here's what makes this particularly interesting for silver. Silver has that monetary component. When people lose confidence in currencies, when they see inflation eroding purchasing power, they buy precious metals. Gold gets most of the attention, but silver has historically been the people's money, more accessible and more widely held than gold. If we get a scenario where industrial demand is pushing silver prices higher due to supply shortages, and simultaneously monetary demand increases due to inflation concerns or currency instability, you could see a feedback loop that drives prices far higher than most analysts expect. This happened in 1980 when silver briefly touched $50 per ounce. It happened again in 2011 when silver reached $49. Both times, the moves were driven by a combination of industrial demand, monetary demand, and supply constraints. But here's what's different now. In 1980 and 2011, the supply constraints were temporary. This time, the constraints are structural. The deficit in copper is projected to persist for decades. The silver supply situation is tied to that copper deficit because of silver's byproduct nature. And the demand drivers, the energy transition, artificial intelligence, electrification, aren't going away. They're accelerating. Think about the implications. If you're a manufacturer who needs copper or silver for your products, and you know supply is going to be tight for years, what do? You secure supply now. You build inventory. You lock in long-term contracts. You pay higher prices to ensure you have the materials you need. This behavior, multiplied across thousands of companies globally, creates additional demand that puts even more pressure on already tight markets. We're already seeing signs of this. Copper inventories at major exchanges are at multi-year lows. Silver inventories have been declining. These aren't abstract statistics. These are physical markets where real companies need real metal to manufacture real products. When inventories are low and supply is tight, prices become volatile and prone to spikes. Let me give you another angle on this. The financial markets are starting to wake up to the supply story. Investment funds are increasing their positions in commodity-related assets. Mining stocks are attracting attention after years of underperformance. Exchange-traded funds backed by physical metal are seeing inflows. This is the early stage of what could become a major investment theme over the next several years. But here's the thing about commodity bull markets. They don't move in straight lines. They're volatile. They have sharp corrections that shake out weak hands. They require patience and conviction. The investors who do well in commodity bull markets are the ones who understand the fundamental supply-demand dynamics and don't get scared out by short-term price volatility. The supply crisis we're facing isn't going to be solved quickly. It can't be. The lead times for new mine development are too long. The capital requirements are too large. The permitting processes are too complex. Even if every proposed copper and silver project in the world got approved and funded tomorrow, it would be years before that new supply came online. And in the meantime, demand continues to grow. This is the setup for what could be one of the most significant commodity market moves of our generation. Not because of speculation or financial engineering, but because of fundamental physical supply and demand. The world needs more copper and silver than can be produced. That's not a prediction. That's the current reality based on existing mine production and projected demand growth. Now, let's talk about what this means for the broader economy. Commodity shortages don't just affect commodity prices. They ripple through the entire economic system. Higher copper prices mean higher costs for construction, for manufacturing, for infrastructure projects. Higher silver prices mean higher costs for electronics, for solar panels, for medical equipment. These costs get passed along to consumers in the form of higher prices for finished goods. This is a form of inflation that central banks can't control with interest rate policy. You can't print more copper. You can't create silver with monetary policy. When physical supply constraints drive prices higher, the only solution is to increase supply or reduce demand, and both of those adjustments take time and cause economic pain. We're potentially entering a period where commodity inflation becomes a persistent feature of the economic landscape, not because of monetary policy or fiscal stimulus, but because of physical supply constraints in critical materials. This is the kind of inflation that's particularly insidious because it affects the cost of producing everything else in the economy. Think about a manufacturer trying to plan for the future in this environment. How do you forecast costs when your key input materials are in structural deficit? How do you price your products when you don't know what you'll have to pay for copper or silver 6 months from now? This uncertainty creates additional costs and inefficiencies throughout the supply chain. And here's where the geopolitical dimension becomes even more critical. Countries that control commodity supplies have leverage over countries that need those commodities. We're already seeing this dynamic play out with energy supplies in Europe. Russia's control over natural gas gave them enormous leverage over European policy. China's control over rare earth elements and battery materials gives them similar leverage over Western technology companies and governments. As copper and silver supplies tighten, as deficits emerge and persist, the countries and companies that control those supplies will have increasing power to dictate terms. This isn't just about prices. This is about access. This is about who gets the materials they need to build their economies and who doesn't. The United States and Europe are starting to recognize this vulnerability. There's increasing talk about reshoring supply chains, about developing domestic mining capacity, about reducing dependence on Chinese processing and refining. But talk is easy. Actually building mines, processing facilities, and supply chains takes years and requires massive capital investment. And even then, the geology determines where the materials are. You can't mine copper where copper doesn't exist. This brings us back to the fundamental reality. The global supply of critical materials is constrained. Demand is growing. The gap between supply and demand is widening, and the solutions to close that gap are years away at best. This is the setup for a prolonged period of tight markets, rising prices, and increasing geopolitical competition over resources. For investors, for businesses, for anyone trying to understand where the global economy is heading, this supply crisis is one of the most important stories unfolding right now. It's not getting the attention it deserves because it's complex, because it's technical, because it doesn't fit into neat narratives about interest rates or stock market valuations. But it's real. It's happening now, and the implications are profound. The question you need to ask yourself is this: in a world where critical materials are in structural deficit, where supply chains are fracturing along geopolitical lines, where the energy transition requires materials that don't exist in sufficient quantities, how do you position yourself? How do you protect your wealth? How do you take advantage of the opportunities that emerge from these massive structural shifts? The answers aren't simple, and they're different for everyone depending on your situation, your goals, your risk tolerance. But ignoring the supply crisis isn't an option. The global supply situation has fundamentally changed. The easy commodities have been found and mined. What remains is harder to extract, more expensive to produce, and subject to increasing geopolitical competition. This is the new reality we're entering. A world where physical resources matter more than financial engineering, where supply chains determine economic power, where the countries and companies that control critical materials have leverage over those that don't. The global supply isn't just tight. In many cases, for the materials that matter most for the future economy, the supply is officially gone in the sense that there isn't enough to meet projected demand at any reasonable price. Understanding this reality, preparing for its implications, and positioning accordingly isn't just smart, it's essential. Because what's happening in the commodity markets right now isn't a temporary disruption. It's a fundamental restructuring of the global economic order, driven by physical supply constraints that can't be solved with monetary policy or financial innovation. The materials either exist or they don't. Right now, for the commodities that matter most, they don't exist in sufficient quantities. And that changes everything.